Hello, my name is Simon Parker. I'm the guest editor of EN, Exhibition News. Today, I am joined by Phil Soar, somebody I've known for a long time. He has probably the most to say about exhibitions with great authority, because he's certainly seen our event business through ups and downs, it's fair to say, but also from when it really started in the UK to where it's come to now. And whilst I've done a written piece with Phil, I thought it would be really good to have a chat just to get, through some of the ups and downs that have happened, and also how the business is faring at the moment. He's currently chair of the 19 group and also Closer Still, so he's very much involved in the sector and has been through lots of different changes, it's fair to say. Phil, how are you feeling today?
Really, really great. Really good.
Phil's not very well. He's had food poisoning, so we'll have to excuse him that. But
not COVID, I promise. Not COVID.
It's not COVID.
And you can't catch COVID in the Hand and Flower, which is the pub opposite Olympia, which is behind me at the moment.
Which is brilliant. So yeah. Phil, we had a really good conversation, and as I said, we've got a piece going out in the printed version of EN. Obviously, this gives an opportunity to maybe put a bit more sort of flavour into that. Just give us a view as to so how did you get into this business, and what was it like then, and how has that changed? I mean, that's a big question, but if you
very big
try,
question.
Try and cover some of it.
Yeah, okay. I was headhunted in 1989. I'd been a publisher before then. I'd been in the publishing world, and I'd had quite a big success in Japan, which had got quite a lot of publicity. Which I can talk about separately. It was noticed by a few people, and I got a call from Blenheim saying, we'd quite like to expand out of the UK into other markets. Would you be interested in joining us and having a go at this? And I said, yeah, why not? What's it worth? And actually, I was actually really very, very pleased for a change of career at that time, because I've been working in publishing, running magazine companies since I left university in '69. So I've been doing that for nearly 20 years, and so it was a good time to change careers.
So go back to that. So what happened in Japan? So did you go over there and?
Yeah, Japan's an interesting story, and I think is a very good example of what you and I talk about a lot, which is just how incredibly important luck is. I mean, it's very easy to talk about we were brilliant at this, we did great at that, we understood this, but actually the single most important thing in any success story is luck, and more luck. I was running a magazine publishing business in Italy, Germany, France, and the UK, and I'd always fancied Japan, because Japan lent itself very, very well to our kind of products. But there was nobody in Japan who was publishing magazines who wasn't Japanese. And one of the reasons for that is that in Japan, the distributors, the equivalent of W.H. Smith, if you like, control the marketplace. In other words, if they say to you, no, we don't want to distribute a magazine, then you don't get distributed. Whereas, say, in the UK and France, if you're publishing a magazine, it's not pornographic or whatever, then Smiths and Relay will distribute it for you. So I went over there. I didn't know anybody. This was 1986, the first time I went over there. The only person I knew was a wonderful guy called Hideo Aoki, who was a literary agent. He sold European books into the Japanese language. He was the only person I knew in Japan. And he had a very interesting background, because he'd been born in Shanghai. His father had been in the Japanese army. Yeah. He'd been a colonel in the Japanese army, and Hideo had been born in 1939 while the Japanese were occupying Shanghai. And as a consequence of this, he grew up learning, speaking Chinese, and he also grew up learning English, because they lived in the English part of Shanghai at that time.
Yeah.
And he had an interesting history. His English was very, very good. And I gradually sort of said, this is what I want to do, and these are the kind of magazines I want to publish, and this is how I want to do it. And he sucked in his breath, as people in Japan do, and say, not sure about that. I don't think Tohan, which is the equivalent of Smiths, are likely to do that. They don't take any non-Japanese publishers, but nonetheless, let's see what we can do. Anyway, got really quite a long story short, because this lasted 18 months, this story. Eventually, we went out to lunch with the president of Tohan, the equivalent to the president of Smiths. We went to a very, very nice restaurant, and we're talking. And he was showing a lot of interest. He was actually being really quite positive, which I was very, very pleased about. And then at one point, he pulled out a photograph album of him in the Second World War, where he was a very junior soldier. He was only about 18 or 19 when the war ended, and he was based in Japan. He was based in Shanghai, I'm sorry.
Yeah.
And he'd been there since he was about 15. And he, by chance, happened to serve in the regiment of which Hideo's father had been the colonel.
Wow.
And I mean, what a stroke of luck. And so as a result, Hideo was translating, of course. We sat there for 3 or 4 hours going through the photograph album, talking about his wartime experience. I mean, you know, this was a young guy. This was not the terrible things that you read about the Japanese in Shanghai, and what he'd done and what it was like. And he remembered Hideo's father. And as a consequence, and I think genuinely as a consequence entirely of that piece of luck, he said, yeah, we'll distribute your magazines. Off you go. And so we were able to do them. We were able to launch. I was able to get everything printed and published. And a year later, we won the Japanese Publisher of the Year award because we sold more magazines than any other publisher in Japan. And there was a wonderful example of what I utterly believe in, that's fundamentally, it's about luck. It really is about luck.
And obviously there's a bit of skill as well, and there's working with the right people and hiring the right people and all that sort of stuff, and it's also, I guess, about timing as well. So then you kind of came back, as you mentioned, and Blenheim, and I guess the exhibition, or the I guess the industry was in its infancy, if you like. Blenheim was seen as a trailblazer and you know, real pioneers. How was that?
Not at that time, of course. No. This is late 80s. This is beginning of 89, really. You and I are working on the AEO's 100th anniversary at the moment, aren't we, Simon, to try and put something on. And so what we're doing is we're looking through the archives. What have we got for the last 100 years? Pictures, videos of exhibitions for 100 years. One thing that's really interesting about it is you can find plenty of pictures of the 20s, 30s, 40s, but you get to the 70s and 80s, and there's a remarkable dearth of visual images. I mean, it sounds crazy. You think, well, there must be thousands of images. But no, it's really, really hard work. And I'm, you know, Nigel Olympia is helping, etc., etc. Andre Montgomery are helping. We're really finding it difficult to find any images. And I think that's illustrative of what was a very quiescent industry in that late 70s, early mid 90s. I mean, Andre Montgomery had got the building show and they got IFE, so they were quite strong. They were quite prominent. But the biggest players were still Reed and EMAP. But of course, they were regarded as printing companies, publishing companies. I think if you'd gone to any of their shareholders, any shareholder in Reed or EMAP, and said, oh, by the way, these people you've got shares in, they run exhibitions, they'd have said, don't know anything about that. What's that all about? You know, nothing at all. And so Blenheim came along in the early to mid 80s and grew quite slowly. And then again, had what I regard as an incredible stroke of luck, which isn't obvious, and it isn't obvious from the Blenheim story. But Laurie Lewis had got a couple of small shows, giftware shows, clothing shows. He met Neville Book, and Neville at the time had been a stockbroker, but wasn't working at the time. Neville didn't know anything about exhibitions, but he knew quite a lot about raising money in the city. And then in 87, there was something called the unlisted securities market suddenly arrived. USM is the forerunner of what we now call AIM. Before then, the idea of floating Blenheim in the stock market, impossible, of course. But USM was completely different. The USM you didn't have to have 3 years of results. You didn't have to have 3 years of profits. You had to have a certain amount of information, a couple of years of audited accounts, but you could actually float on the unlisted securities market. And because of Neville's skills in that sector, we were able to do that in 87, I think it was, when the USM was very new. And I think we were valued at £1 million. But the stroke of luck is because of capital gains tax. Now, at the time, you're too young, Simon, but there were plenty of people that remember late 80s, early 90s, and I'm talking about the UK, France, Germany, our main marketplaces. Capital gains tax was somewhere between 50 and 75%. So if you were a business, you were making £1 million, we went along and say, we'll give you 4 million for your business. One of the problems was for the seller is that automatically he or she would lose somewhere between 2 or 3 million pounds. It would just go in capital gains tax. Because we had this quota company, we could actually issue paper to people. We could say to them, we'll give you £4 million, but we'll give it you in shares. In other words, you take the shares, you'll pay capital gains tax eventually, but not just yet, at some point in the future.
Yeah.
And you'll get dividends because we pay dividends, and hopefully the value of the share price will rise. And so eventually your shares will be worth far, far more than the 4 million, and you'll end up paying less capital gains tax, and you'll get the dividends in the interim.
Wow.
And so this was extremely attractive to people. Rather than suddenly paying 2 to 3 million of their 4 in capital gains tax, they were actually taking the paper, putting the paper in the drawer. And of course, as it happened, we went from 1 million in 1887 to 593 million in 1996 when you guys at UBM bought us. So it wasn't a bad investment for anybody who had chosen to take the paper. But again, a real stroke of luck, because it only happened because we could become a public company in that very fortunate situation.
And is it fair to say, though, at that time as well, that the exhibition sector wasn't necessarily as looked upon with such, sort of enthusiasm as it is now? There weren't that many people wanting to buy those businesses, or that there probably were a few, but there certainly wasn't private equity and lots of people, trying to vying for position.
It was basically invisible, and it was invisible compared with magazines, compared with newspapers, compared with TV, compared with radio. And I do have a favourite cameo, and you know it quite well, Simon.
Yeah.
But it's absolutely spot on. 1989, Blenheim bought the single biggest show in France, which is called Batimat. And we bought it for about 8 million sterling, and that was about 3.5 times profits. The same month that we bought Batimat, an American magazine called TV Guide. Now, anybody who goes to the States a lot knows then and now, every supermarket checkout has got a little pocket paperback called TV Guide, and it does what it says on the tin. It's a guide to your local TV stations. That magazine was sold by a guy called Walter Annenberg in 1989 for $3.7 billion, not million, $3.7 billion. And that was the highest amount of money that's ever been paid for a magazine before or since. Now, if you go forward 20 years, just 20 years, go through it forward to 2009. I'm picking 2009 for a reason. At that point, Batimat and its offshoots, Moscow, etc., were owned by Reed. And it's difficult for me to put a number on it because Reed didn't isolate it separately. But I would certainly think 300 million. It would be a reasonable valuation for Batimat, but perhaps more than that. So it's gone in 20 years from 8 million sterling to 300 or 400 million sterling. That year, 2009, TV Guide was sold to a private equity company for $9 million.
Gee.
So it had gone from 3.7 billion to $9 million. It was still TV Guide. It was still at all the checkouts, but it had lost 99.8% of its value in those 20 years. And that, of course, is the story of exhibitions, that from the period 1989-90, when it was possible for Blenheim and Reed and EMAP to pick up events at 3, 4, 5 times earnings and grow those events. Magazines, newspapers were costing 20 times, and in 20 years, the market just reversed itself completely. So again, phenomenally lucky time to be in there buying exhibitions. But to be fair, 1 or 2 people spotted it. Mike Rusbridge spotted it. Neville Book certainly spotted it.
Yeah.
And those were the companies that actually built enormous value over that period.
So the next sort of chapter in that story then was you left Blenheim. And then what did you do after that?
Oh, I did a number of things. I still had my publishing company. So I was always involved. It was French-based publishing company. And I was always involved in that publishing company right through to 2011. When in fact we sold it to a private equity company in 2011. I also did other strange things like buying football clubs, which was a particularly perverse thing to do and didn't make me very popular with my wife or my children. They thought it was a very, very odd thing to do. But
you're still involved in football or not?
Only in the sense of being a writer and an author. And I give speeches up in Nottingham quite a bit to things like supporters associations, because I'm still the official historian, and I talk about the history of the club and what it all means and why the club has just lost another 77 million pounds and what will happen as a consequence of it. That's way out of my league. I wasn't myself and Nigel Ray funded that deal, and we certainly weren't in the business of spending £77 million, that's for sure.
But you could still hear the clarion call of exhibitions and events.
Yeah,
and you obviously did. What did you say? 2011. You sold the publishing business and then got back straight into exhibitions, or?
No, I'd already been back. I mean, one of my favourite stories is Spearhead, and Spearhead that used to own the SCI, used to own Offshore Europe, used to own Oceanology, used to own Helitank. A guy, myself and a guy called Bob Munton, bought Spearhead from its owners, which was a US company that ran theatres for some reason, and we bought it. And we bought it in October 2001. And we sold it in August 2003. And the nice thing about that story is we owned the business for 22 months. And in that period, we never ran an exhibition.
Wow.
All of the shows were biennials, and they all ran in that 2-month period. And we didn't run them. So from buying to selling at reasonable amounts of money, we never, ever ran an exhibition.
And then where does so Ithaca, I'm trying to get my dateline right. So
yeah, Ithaca was 2005 with Andy and Phil and Michael. And that basically was buying Penton's European exhibition assets.
So then,
sorry, it was earlier. It was about 2003. We bought Penton's European exhibition assets.
And going back to your theme of luck, was there any luck involved in that, or was that like-minded people? And
there was luck in the sense that Michael and Phil and Andy were working for Penton at the time, trying to run. Internet World was probably their biggest brand at the time, and Penton, of course, had a major collapse. 2001, the 2001 crisis, and they just fell apart. Their publishing and everything in the States, they were Cleveland based, and they were basically just trying to sell off everything. And so they came to Andy, who was their chief executive, and said, well, I tell you what, if you guys just want to take our European exhibitions, guys, you can. I mean, what do you want for it? And I think Andy said, oh, what about 2 million? And they said, okay, then. And so we raised a small amount of money from a small venture capital company called MBM, who then stayed with us for another 13 years. They stayed with us as an investor, and of course Ithaca built very nicely from there.
Well, yeah, and I guess there was also a bit of luck in the exit in terms of the timing of.
Well, yes, it was a bit lucky, wasn't it? Yeah, I think it was very, very kind of you and your colleagues to buy the assignment.
Not so lucky for us.
Yeah, we thought that was very, very nice of you to do that. It happened to be 3 months before all of the tax rates changed dramatically, which was quite fortuitous, although we had predicted that.
But joking aside, and I take on board that there is an element of luck needed in everybody.
Okay, it was 2008. Okay, let's admit it.
Yeah. Right. But you've also, I mean, through your track record, you've backed great management teams, great, really talented individuals. You've made some amazing.
Also Chris Hughes as well, of course. I mean, if you want to include him in this.
But there's luck and there's judgment, and there's also, as I said, picking those, sort of making those right decisions at the right time. Can you distill that in terms of those management teams and those decisions that you made? Because if you look at now bringing it more up to present day, with 19 and closer, they're incredibly fast growing businesses. That's not all luck, is it?
No, I mean, I don't think it is luck. Sorry, it's in large part luck, of course it is. It's actually quite hard. I mean, if you were to say, as private equity houses always look at you and they say, well, what's the secret sauce then? What's the secret sauce? And you look at them and you think, I haven't got a clue, but I suppose I'm going to have to say something, aren't I? I mean, any success is what I tell my children. I'm sure you tell your children as well. I mean, it comes down to three things, really. It comes down to intellectual rigor. That's actually really important. I mean, don't just go into something because you like the looks of it. You work away at it at level 1, level 2, level 3, but you don't really dig down. You need the intellectual rigor to say, why am I doing this? What does it mean? What's the position? Number one, real intellectual rigor. Number two, determination.
Yeah.
Determination is remarkably important because I have seen very often us succeed in situations where we arguably didn't expect to, because the other guys weren't actually determined enough. And I think you find this quite a lot when you're a relatively small company, in the way that Closer Still was when it started, or 19 was when it started, though 19 is quite a lot bigger now. And you're playing against the big guys, we won't name any names.
Yeah.
And the determination isn't there in the same way with the big guys, because the people that are making decisions are 2 or 3 divisions lower, and they're looking at the Excel spreadsheet bottom right-hand corner, and they need to achieve X, or they won't get their bonus. Therefore, what costs can they cut, etc. I'm not being unkind.
No.
But, we all know we've been there, and there isn't the same determination. I've got to make this work. My house is on the line, etc., etc. And the third one, above all else, is luck, or call it serendipity. And the third one is really, really important. And I don't think anybody does it without a good dose of luck.
No. So then, I was just then thinking about, and we talked about it when we met, but also the structures by which you operate those businesses. So, the share of equity and the way that you involve the whole business feels vested in it. Do you think, I guess that's also part of the success as well?
Yeah, it is part. Actually, Blenheim was an early example of that. I mean, Blenheim was actually very, very good and did issue shares, or more accurately, share options at the time, because it simply wasn't tax efficient to issue shares because people had to pay for them. But we did issue share options right across the board. And a lot of people did very well out of that when we eventually sold to yourself, Simon, and those nice friends of yours. But Ithaca distributed shares very widely. Closer Still is probably the only company that I know in the industry where effectively everybody gets shares. And I mean shares, I don't mean share options. I mean shares. And that was a decision made very, very early on when we first started, that we would do that, and we would hopefully reward people that way. And of course, it's easier when you're small. We started with nothing. Andy and I had a meeting in a coffee bar. It was just myself, Andy, guys from NBM, £3 million on the table, no people, no shows, nothing, no office, nothing. It's much easier then to say, okay, we will now allocate 20%, and those will be allocated to the staff, because at that point, the shares aren't worth anything. So it's quite easy to give shares that aren't worth anything to people. Quite easy to make those decisions at those stages. And then, of course, it grows and grows, and you get to a size when we had, 400 people last year, where it gets much, much harder to manage. Of course.
Yeah.
But the underlying principle, I think fundamentally it has to be a good one. It was done as a matter of principle, not because we believed the company would be more successful as a result of it.
Yeah. And then we talked when we last spoke about private equity and the impact that that's had, and I kind of touched on it a little bit a while ago. But that clearly has had a big impact on your world and your life.
It does massively, and I could talk about this for the next 3 hours. But
it's a force. You see it as a force for good. I mean, if you had to, I know that's quite binary, but do you feel that has had a positive impact on our industry?
I do broadly, because it means that the assets that we're all working with have been valued significantly more highly than they would otherwise have been. And that means there are plenty of occasions where people, other small companies as well as large companies, can actually generate more worthwhile sums of money for their efforts, which in fact, you go back to the 1990s and you couldn't really do that. I mean, you could be a relatively small exhibition company and you could be plowing your own furrow, but in fact, what were you doing? I mean, you were trying to increase your profits every year. You were hoping you could increase your salary a bit every year. Maybe if you owned the business, you'd pay a bit of a dividend. But there wasn't a great pot of gold at the end of the rainbow. It was something that you could well be doing until you retired. And that changed very much with the entree. The first private equity investment was about 98, 99. First one I did was Spearhead in 2001. But it changes things in a whole range of ways. I mean, just very briefly, Cameo, again, we talk about it a lot. between the beginning of 2018 and around the middle of 2019, private equity spent 3.2 billion pounds on 5 exhibition assets in the UK. And if you add to that the 3.8 million that Informa paid for UBM, in that 18-month period, you had 6 transactions for a total of over $7 billion. Sorry, £7 billion. Apologies. Now, people start throwing £7 billion around, and it's going to change an industry. It doesn't matter what the industry is.
Absolutely.
£7 billion is one hell of a lot of money.
And yet, somebody like Blackstone, Simon Kimmel was saying that they manage something like, I don't know, 561 billion pounds worth of funds.
700.
Okay.
Yeah. 700 billion. So it's the 1.4 billion that they spent on the NEC and Clarion is I wouldn't call it a drop in the ocean, but you know what I mean.
Yeah.
It's not life changing from the people that own Blackstone, that's for sure.
And do you think those businesses, so culturally, I was just trying to think about, having worked with private equity recently, obviously they bring a rigor, a discipline and process to a lot of what we do, and that I think is in the main really positive. Yeah. And do you think that has then changed those businesses that are involved with PE?
Yeah, I mean the most important way that it changes things is it changes entirely the timescale. If you go back to Blenheim days, early 1990s, then basically Blenheim was growing quite fast. We got up to about 50 million profit, but at no point did we think to ourselves anything other than, okay, we keep going. We get a little bit bigger. We maybe get to 60 million profit or 70 million profit. We can maybe pay higher dividends, etc. But we weren't doing it on the basis that, Christ, somebody's going to come out of left field and suddenly say, here's a check for 900 million. You weren't doing that. You were just basically running the business. Yeah. Whereas with private equity, very, very clearly right from the start, and I think most people know this, private equity work to define cycles. They go out and they raise money, typically from pension funds or from university funds or from family funds, and they raise that money historically, typically for 5 years. They raise the money for 5 years. They say, we'll invest it and we'll pay it back to you in 5 years. That's stretched quite a bit more. That 5 has now tended to become 7 or 8. But the underlying principle stays the same. They actually go out, they invest in product, and then they will sell those businesses at a defined point, because that's when their fund comes to an end, and that's when they have to pay their investors back. So what it does is it creates a pressure point on the companies that are bought. Let's take the 5-year figure, for instance.
Yeah.
Actually, we all know very well, if you let's say you've got a 5-year timeline and it's year 3, actually you say to yourself, that's a really good launch. I should really try that. It's a big IT show in the States. You're going to invest a lot of money in it. And somebody says, but hold on a minute, you go and do that. You're going to spend $1 million. Yeah. What are you going to do in year 2? Oh, hopefully in year 2, we'll maybe only lose 300, 400,000. Yeah. What about year 3? Well, if we're really lucky, we'll break even in year 3, which is the standard, stuff for an exhibition company. And actually, the answer will be, well, just don't do that, because the business is going to be sold in 5 years' time, and nobody's going to give you a penny of value for your great show, which is not making any money.
So there's a massive flurry of activity within the first sort of year of the transaction.
Particularly launches, particularly acquisitions. It doesn't mean you won't make acquisitions later on, because an acquisition, brings you EBITDA immediately. Of course,
but launch is less so.
But logically, you make an acquisition. You hope to grow that acquisition, double the EBITDA. You launch something. By year 3, it's making a profit. So you actually focus on doing that very, very early on. Yeah. And that is the norm for all private equity investments. The exhibition company is no different from any other. And that does create an element of timescale for the business. And it also creates an element of timescale for the employees, particularly employees who've got shares. Yeah. Because they understand it. And they understand, therefore, what the business is trying to do. And they understand that they can hope at this point in the future, they will be able to sell their shares for X, Y, Z. So it's a kind of calendar constraint which was not there before.
No. So look, Phil, I mean, I've known you for many years, and I've loved working with you. And one of the things that I love is that, you know, as this conversation illustrates, your undying enthusiasm and passion for this for this sector, and that's evident, and that doesn't seem to sort of dim over time. And I'm just thinking, what next? I mean, what will you continue doing this for forever, or can you?
I would say my mother's 97, lives in Italy. It's nothing going wrong with her at all. Yeah, maybe 97. Yeah, I could think about it.
Yeah, but you seem to be as animated about it as when I first met you. Do you feel that way?
I think the whole area of what exhibition companies are, and this really started with Blenheim, what they are and what they can be, is really important. It really is amazing. You go back to early days, and people often say, why is private equity so interested in exhibitions? Like, my answer is, what's amazing is they weren't interested in exhibitions so much earlier. Because you look at it, you look at the industry, the cash comes up in front, up front. Lots of our business, virtually all of our significant size businesses have margins of 25 to 30%.
Yeah.
They just do it great, have wonderful margins. You can build a wall around your products because the slot system everywhere in the world, even in the States, where there are plenty of venues, allows you to build a wall around your product and makes it very difficult for people to invest in you. I mean, these are tremendous assets. People find it very, very hard to compete in a lot of the markets we're in. And you look at those three things and you think that's absolutely perfect for private equity. It's a kind of dream come true.
But then I guess then COVID comes along, and you know that what they thought was this great success story then falls off a cliff. I mean, do you think that will put them off in any way?
Well, I ask me in 5-6 years' time.
Yeah.
Is the simple answer. We're not seeing it at the moment. We're actually finding all the big. I think I'm correct. All of the big private equity companies are being very supportive of people like Closer Still 19, Clarion, Tarsus, NEC. These are all private equity owned. And while they're sort of paying attention, of course they are. Nobody's putting excessive pressure on. Nobody's saying, "Christ, cut your staff by 50%." This isn't Reed.
Yeah.
Everyone is saying it's okay. It's okay. We believe in the sector. We're big organisations. We're not scraping around for the last penny. You're okay. You believe in it. We think in a year, 2 years, 3 years' time, this sector will come back, and it may well be that you guys will be stronger because you'll have stronger positions within that industry. So every one of the big private equity companies that I deal with, there isn't a single one who is causing any problems for their exhibition group.
Well, that seems like an appropriate time to end. You're absolute legend, and great talking to you, even though you're not feeling too great. I didn't come over, so you...
Leg end, we used to say at Forest. You
sit down
with one of the guys who'd won the European Cups and say,
Are you coming to
Gary? Leg end, they say, and show you.
Are you coming to Confex?
Oh yeah.
Just say, I was going to say, you have to say. I mean, there's only one answer to that, isn't there? Yeah.
We used to run Confex.
Yeah.
Great show. Great show.
Well, I've just done a retrospective actually in the printed issue with people. Anita, can you remember Anita who used to run it from?
Oh, Anita Harris.
Anita Harris.
Anita Harris.
Yeah, I managed.
Debbie Cameron.
Yeah, I managed to speak to her and Johnny and Duncan and a whole range of people. So
Debbie tell you about the snowstorm and how we were completely snowed in for 2 days. And
she mentioned that, and apparently she went round with mulled wine on a trolley.
That's right. Yes, everybody was stuck there for 2 days. Yeah.
Everyone has a Confex story. Philip Soar, thank you so much for your time. Great to speak to you. Thanks very much.
And I'll get back to the 100 years, okay?
Great stuff. See you later.